And welcome everyone to our economic presentation. I'm Seth Meisler and this is Marc Usem, and we are part of the investment committee within Affiance Financial, and we're really glad you could be here. I think this is the fourth or fifth time that we've done this now in terms of talking about markets and giving kind of a market update. This is the second time that Marc and I have done this together, and this is the first time that we've actually been completely full for both lunch and dinner. So I'm not sure what this says about my presentations, but prior to having you here,
you got it revved up. You got it revved up.
But we're really glad you're here. We do have a lot to say, talking about where have we been and where are we going, and as well as talking about the firm and what we do. A couple things. One is, one of the beauties of our firm is that we have a lot of different financial advisors with a lot of different thoughts. And so what you're going to hear is really thoughts of Marc and I in terms of what we think is happening. Obviously, no guarantees, but it is really how we see things. Second thing is, we really aim to be apolitical. So hopefully you walk out of here not knowing whether we're a Republican or a Democrat or what we think is going on. That being said, clearly what happens in government does have an impact on the economy and on the stock market. And we will be addressing that. We will be talking about those issues really from an economic and stock market lens and not from any sort of political bias. The topics for today are going to be about the Affiance investment process, overview of where we've been in 2017, as well as outlook for 2018. And finally, we're going to have question and answers. And with that, we'll have Marc kick it off with regards to the investment process.
Thanks, Seth. The Affiance investment process is really focused initially around the investment committee. There's 6 members of the committee. Seth and I sit on the committee, the partners of the firm, 2 other of our advisors, and our chief compliance officer is an observer. The committee meets bi-weekly, and we're reviewing what's going on in the economy, what's going on with our portfolios, and so we're really trying to stay on top of things that are going on all the time. The committee sets the investment policy for the firm and also creates the recommended portfolios for the firm. We also use a third-party consultant. So we try to avoid groupthink. We look outside to have other people look at what we're doing and say, hey, are we on the right track? What other things might we look at? What should we be thinking about differently? We take a risk-based approach to portfolio construction, meaning when we build portfolios, we're really looking at risk as the primary factor and then trying to maximize the amount of return for a given level of that risk. It's a little bit unique in terms of many people approach it the other way and say, hey, here's a portfolio, I'm trying to get this much return. And so we kind of have a little bit different view of that construction process, and again, really focused on the risk side. We invest a lot in software. What we do is hard to do for many, many clients and literally over 1,000 portfolios. And so we need software to help us manage that process, to rebalance portfolios, and to manage all the information that we deal with. So it's a considerable investment there. We write quarterly commentary. So you'll see with your quarterly statements, there's quarterly commentary that talks about what we think is going on in the market, what's going on recently with portfolios. So our commentary is something that we focus on. And then periodic updates about what's going on in the economy. We don't have a schedule for these, but if there's something we think is particularly topical, we'll send out an email or a letter to say, hey, here's something we're looking at, here's something we're focusing on, you should be aware. So that's kind of a big picture of how we sort of operate from the investment side. We take a great amount of humility in what we're about to try to do. We love the quote by a famous economist, John Kenneth Galbraith, who said, the only function of economic forecasting is to make astrology look respectable. We hope we can do a little better than the astrologists, but the facts are the facts.
So where are we in 2017? Really, it's a story of what happened in 2009 in terms of the recession of 2009, how we've recovered from the recession in 2009, and where are we going forward. And so it's been 9 years since the start of the recession, and about 11 trillion in global central bank stimulus, and here we are today. And really, it's a story about what we've been calling kind of in the past, economist Brian Westbury said, it's been a plow horse economy. In other words, we've been moving forward, but it's been moving forward at a slow at a very slow but steady rate, still moving forward, still positive, but slower. And what we think is that horse is beginning to trot. The slides that we have are going to show you why and how that market has reacted to that. About a year ago when we gave the presentation, we talked about that we saw a turnaround in terms of corporate earnings, and that was going to translate into stock market performance. That being said, it did wildly better than we would have anticipated. We were a little bit more concerned about the pace of recovery in Europe. We still thought it was going to move forward, but certainly not at the pace of the United States. And that actually exceeded expectations, as you'll see in the next slide. US earnings were up 17%, just a tremendous improvement in US earnings. And so when you see big numbers in the stock performance, keep in mind that earnings actually grew by a very robust amount. And that earnings did translate into increases in stock prices. Volatility was unusually benign. Every single month of 2017, the stock market, as we look at the S&P 500, the 500 largest US companies, was positive every single month. That's extremely rare for something like that to happen. And inflation, long-term rates were really pretty quiet. And that was something that we talked about, this theme of lower for longer. And what we mean is lower interest rates for a longer period of time than people are expecting. And that really played out in 2017, that actually at the end of the year, 30-year interest rates were less than they were in 2016. Not by a lot, but still that theme continued to play out. It may diverge in 2018 a little bit, but we still think that long-term in 2019 and going forward, that lower for longer theme is really going to be with us for a while. And we'll talk about why. On the positive to the stock market and economy, we had tax cuts and deregulation. And that's kind of been the theme in the current fiscal environment in terms of what the government has been doing, reducing two rules for every one that they have been adding, as well as the tax cuts that passed in 2017, the end of 2017. And you really see the market is trying to adjust to this information in terms of, again, lower tax rates leading to higher corporate earnings, leading to higher stock prices. And finally, the Fed raising interest rates 3 times to 1.5%. So each time they raise it by 0.25% to 1.5%, and leading to so actions that they're doing, which we think are creating somewhat of a speed bump. And again, what a year. 21.83% for the S&P 500, including dividends. So really just an incredible year in the S&P 500. What I do want to point out is if you look at small caps and mid cap stocks, performance was quite a bit different, quite a bit less than the S&P 500. So again, small cap stocks with a return of 13%. So it really depended on what type of companies you owned or in terms of performance. Again, 13% is a great return. It's far greater than the average stock market return, but the differences are noticeable. The other thing I want to talk about is large foreign companies, international developed, and emerging market countries. Performance there was 25% for large foreign developed and 37% for emerging market. And so quite a big improvement. And keep in mind, emerging markets for 10 years did nothing. Just really flat returns, zero, negative. And in 2017, just a tremendous performance. That being said, if you translate the returns into their local currency, what you actually see is that large foreign developed had a 16.7% return. So in other words, a big part of the return was the falling dollar in 2017. And that actually the foreign developed did not have as high returns compared to the US in local currencies. But obviously once translated into US dollars, foreign did significantly better than US. And finally, I want to talk about the return of oil. So oil was up 12.5% in 2017. That did not really translate into stock performance for energy companies until December of 2017 and January of 2018. Again, really big improvement in oil. We think that's a big story in terms of how that impacts the economy in the United States. And we're beginning to see that play out. If anything, we were early in terms of our positive outlook on what was happening. But again, we're certainly seeing that happen right now.
So we want to highlight this divergence in performance recently. So this is a graph showing growth versus value over about the past decade. And clearly, we see growth outperforming value. Now, growth stocks are stocks that are growthier. If you cut the market into two, the highest growth stocks are those with the highest earnings growth rates. They tend to have the highest valuations measured by PE ratios or price to sales ratios, while value stocks tend to be growing a little slower and have lower valuations. Companies that are growth companies you might recognize like Apple, Microsoft, United Health, Home Depot, and on the value side, energy companies, banks like a US bank, Wells Fargo, Exxon. Those are different groups of companies, if you will. So if you cut them in half, you can see over the past decade, large cap growth in particular has outperformed value by almost 100%. So pretty dramatic. So being invested is really important. Being invested in the right areas made a big difference. Now, the thing that's also interesting is that a lot of academic research has shown that small cap value is the best performing asset class over long periods of time. Well, you have to live that long too. But you can see that this is 11 years. I mean, so we've really got a huge divergence here. And our expectation is actually at this point, this trend continues.
So again, we talked a little bit about the stock market and where the stock market's been in 2017. We're going to shift gears a little bit and just talk about the economy. And again, what we're seeing is in the blue is where we were at the end of 2016, third quarter of 2016, and in green is where we are today. So a big, robust pickup in economic activity, really on multiple measures. You can see in terms of GDP, in terms of economic activity, a year ago we were at 1.5%. This is the third quarter of 2017 at 2.3%. And the newest release, we just got results on Friday that said we were at 2.6% for the last quarter. So again, this continued robust economic growth. Skipping to retail sales, again, you've heard about the Amazon effect and everything else, but regardless, retail sales continue to grow quite significantly from 3.1% to 4.4%. New jobs added in October of 2016 were 124,000. New jobs added in October of 2017, 261,000. And in terms of manufacturing activity, we look at something called the PMI as a measure of manufacturing. It's a manufacturing index. And again, jumping from 52 to 58.7. Above 50 means that companies are investing in manufacturing capacity. And inflation did increase from a year ago, but still relatively subdued. Again, looking at the manufacturing activity going back to 2008, right, here's the recession in the 2009 recession, a really steep pickup in manufacturing activity. Just showing, again, that the recovery that we're seeing, it is a broad-based recovery that we're seeing in terms of growth in manufacturing, in spending, and translating into the stock market.
So looking at GDP, this is a fairly long-term chart. So GDP is gross domestic product, or the value of all the goods and services that the United States creates. And going back to the 80s, you can see the dips in GDP in front of the shaded areas, which are recessions. The 2008 recession is particularly dramatic, and the recovery is dramatic. In all cases, the recoveries are fairly sharp. In this case, the recovery was sharp as well, but since that time, growth has been relatively modest. It's been around that 2.5% range. So looking at prior recoveries, they've gotten up to 5% or more. So it's been a more subdued recovery, and we're still sort of in that mode. In fact, fourth quarter GDP came out the other day, and it was 2.7 for the fourth quarter of last year. So still in that range.
If you look at past recoveries, aside from the immediate bounce back, the recovery since 2007 or so has really been a shallow recovery. Much slower growth than what we've experienced in the past, and much slower growth than on average the United States has experienced. So post-World War II, averaging roughly about 3%. Since 2009, our growth has been roughly about 2%. So a significant decrease in general growth. We think that also could be part of the story explaining why we think the growth story is going to be longer than one would normally think, simply because of the fact that it's been a lot shallower. Looking back at the economy, The one thing that we did notice was this drop off in 2015 and leading into the beginning of 2016 as well. And at the time, that got us nervous. Like, what was going on? Why was growth dropping? And what could be happening? So
we said, let's look at the states. What's going on in the United States? And we showed this slide last year. And you can see the middle of the country was actually in a recession in the middle of 2015. What had happened? Oil prices had fallen. They'd fallen by almost 75%. The lows were about $25 $25 a barrel. And you can see the impact on the country. Now, the coasts continued to grow. And so overall, GDP for the country was positive, although a fairly small number, 1.5%. Contrast that with this year, and the entire map is blue. So all of the states are generating positive growth. And you can see the commentary on the side. The biggest reason for that is the rebound in oil prices. Almost every state, the oil return has been a significant contributor to state growth. So massive change. Oil is really the catalyst that's been the difference over the past year. Very interesting that the states have recovered this way. So now we're in a much more even economic growth scenario.
Right. So, and what we called this period over here was that we were in what we called the stealth recession. In other words, in 2015 and leading into the beginning of 2016, we were actually in a recession and just no one knew it. If you lived in those states in the middle, you were living it, you were experiencing it, but on the coasts, they weren't necessarily experiencing it. And the coasts were growing large enough to basically kind of hide the fact of what was happening in the middle of the country. And you can see that in stock market returns in 2015, including dividends, we were positive. But if you strip out dividends, the stock market was negative for that year, S&P 500. And again, we were scratching our heads like, what's going on here? Like, all the signals seem to be pointing downward in 2015 or so, but the stock market was still moving forward. And again, that's why we're calling it the stealth recession, that we actually experienced a recession and we were coming out of it in 2017. It's just no one realized what was happening. And you could see that even with earnings as well, right? In 2015-16, there was a big drop off in operating earnings for the stock market. And we had this, and again, it was just getting larger and larger and continuing to grow. And then it flipped, right? And we started seeing this flip in the end of 2016. And that's what we talked about a year ago, is that we were beginning to see this flip in operating earnings. And we thought that we were effectively coming out of a recession. And you're really seeing just really strong growth in operating earnings in 2017. And what appears to be continuing into 2018 as well. So not only are the top line numbers just really big operating earnings increases, 17, 18% per year, but just the change from where we were, minus 12% going up to now 18%. And thus we think that there's a rational explanation in terms of why the US stock market has really performed the way it has in 2017. So that's, again, kind of where we've been over 2017 and trying to explain what's been going on and why. We're going to take a step back and get just a little bit theoretical for a moment as we start looking into 2018 and try and think about how do markets work and what actually impacts markets.
So these bubbles represent the relative impact on the market. Don't take them too literally, but all these things influence the stock market, either directly or through the economy. So monetary policy, probably the biggest lever out there that affects stocks and the economy. So the Fed drives monetary policy. We talked about that a little bit. Fiscal policy, the other really big lever. So the government, if they make changes in tax code, spending, these things have big influences on the economy and the stock market. Corporate earnings, of course, are a big one. Seth just showed the corporate earnings. Went down, recovered, markets responded, and clearly monetary policy and fiscal policy affect corporate earnings, and corporate earnings affect the stock market. Finally, demographics and technology are two other levers, if you will. In demographics, we look at what's happening in the economy broadly with people. So we have the baby boomers getting older, retiring, and changing their spending habits. On the other side, we have the millennials and the Gen Xers coming into the economy, still working and growing. Those things actually look like they're balancing each other and maybe even accelerating in terms of millennials and Gen Xers replacing the baby boomers. The other side is technology. So technology has been a factor kind of forever in different ways. So go back to the Industrial Revolution all the way through to Facebook and Apple, and it's always been an issue. But technology is even bigger today, I think, from the perspective of many of the largest companies in our economy today probably weren't even in existence 15 or 20 years ago. So we've had a really big technological change that's driven things broadly in the economy. So this is sort of the story that we are talking about today in terms of what's happening in the market. So we're in a little bit of a fight, arm wrestling, if you will, between the Fed and the government. So fiscal versus monetary policy. They're fighting each other because while the government is trying to heat up the economy through tax cuts, deregulation, infrastructure spending, at the same time, the Fed's trying to cool the economy because they think things are starting to get hot. So they're fighting each other, and we'll see in the end who wins. Does anybody know who's going to win? Well, the Fed's never lost, okay? So they're whatever, 1,000,000-0. But it's a matter of when and how. So these two things have really a big effect on GDP and corporate earnings, and we'll talk a little bit more about that.
Right. So we're going to start from the from fiscal policy in terms of what government is doing and how that's been impacting the stock market and economy. And really, what we think is that they've been basically throwing kerosene on the fire. In other words, really heating things up. And as you may know, there was a tax bill that passed at the end of 2017. And while there was a lot of talk about how that's going to affect individual investors, in general, we think that's really quite modest. The big story that we believe is how that's affecting corporate taxes. So corporate taxes were at 35%. We were one of the highest corporate tax countries in the globe. That's dropped now to 21%. So why did they do that? What happened? So effectively, they wanted to stop companies like Medtronic who move their operations overseas. They wanted to stop that. They also wanted companies to move their operations and not move their factories overseas as well, and have that local, and also bring back money from that they earned overseas and bring that back into the United States. So that's what they're trying to accomplish. And again, you can see they've become much more competitive globally with these actions in terms of lowering corporate tax rates. Regardless of how you think about it, again, politically, we believe that this is going to, at least in the short term, is going to be positive for economic activity. How much exactly? There's lots of people have different opinions with regards to what the impact is, but regardless, the opinion is uniformly positive. Could be a 0.8% increase to economic activity, could be 1.5%, but regardless, any way you slice it, it is positive to economic activity and growth in the United States for 2018.
So focusing just for a second now on the Federal Reserve, the Fed has what they call a dual mandate of maximizing employment, stabilizing prices, and I don't know why they call it a dual mandate, but there's a third leg, which is moderating long-term interest rates. So maximizing employment, they don't have a number per se, but they talk about the 4 to 5% unemployment rate as sort of being full employment for the United States. And then interest rates, inflation, they target at about 2%. And that's a number that they've decided is what they think a stable and good level of inflation is for our economy. Long-term rates, they really don't have a, again, target here per se. They just don't want them to be volatile.
So how's the Federal Reserve done on the employment front? We would say pretty good. October of 2009, unemployment was 10%. In October of 2017, the unemployment rate was 4.1%. So we would call that basically that we are today at full employment. And so they've been very successful in accomplishing their objective in terms of where they wanted those numbers to go. What's also interesting is the dark line is the unemployment rate. The light line is the wage increases. And what you can see is that generally speaking, as the unemployment rate drops, wage growth goes up, right? And that makes sense Companies are trying to hire employees. When unemployment goes down, they're having trouble finding employees. They tend to increase wages as they're increase salaries as they're looking for those employees to hire. And what's interesting is that over the last several years, that has really not happened, where the wage growth has been relatively flat. So that's been one of I guess, the mysteries in terms of the Federal Reserve of what's been happening, because that's a big driver of inflation. And during Q&A, we can talk about the reasons we think that that's been the case. But regardless, I mean, the story is unemployment has been hitting Federal Reserve targets. Wage growth certainly has not.
So this is a long-term view of the Fed funds rate. The Fed funds rate is the main tool that the Federal Reserve uses to influence the economy by influencing interest rates. This is the short side of the curve, the shortest maturities. But you can see over time, there's been quite a change. So the 80s was the massive inflation that Fed Chairman Paul Volcker squashed by raising rates to almost 18%. Since then, it's been generally downward trending, but they have raised rates as they've needed to try to cool the economy. And you can see the result generally is that the economy will go into a recession. Since the Great Recession of 2008, rates have been almost zero for almost a decade here. And they just started to tick up as the Fed's trying to normalize back to that probably 4-ish, 5-ish% level of interest rates. Again, they haven't set a target, but that's probably the range they're going to shoot for.
And in general, there are usually two factors that we see that accompany recessions. So the first one is that, generally speaking, the Federal Reserve is raising rates to kind of slow down the economy. Federal Reserve overshoots just because of a lag of information in terms of what they're trying to accomplish. And as such, that is one of the causes that leads the economy into a recession.
That's a great point. Think of the Fed as steering a really big ship, and it takes about 12 to 18 months from the time they turn the wheel till it moves. So this is real GDP and the Fed funds rate. So this, again, is an illustration of what's going on with the Fed funds rate and GDP. And you can see that as they raise interest rates, the Fed funds rate, it tends to slow the economy. So they have a fairly inverse correlation. And that's been sort of the case over time. Back here now, since 2008, you can see that Fed funds rate's been zero. So you can't really see anything going on. And to some extent, we think that as that Fed funds rate gets very, very low, the effects are muted. It's not clear that changing interest rates 25 or 50 basis points here or there when rates are that low really has much of an impact. And so again, you can see starting to try to normalize rates here at the end of the day.
In terms of where the Federal Reserve thinks it's going to go, you can see in the top line here, the dotted line with the blue diamonds, is basically where the Federal Reserve is stating that that's where they want short-term interest rates to be going into 2018, 19, and beyond. But what's interesting to note is that the market is saying something else. Looking at what the market is saying of expected interest rates is a much lower number, relatively speaking. And so again, we're kind of in this situation of now the Federal Reserve obviously calls the shots, and they can decide how frequently they want to raise rates, as well as what that percentage. They don't need to raise rates 0.25. It could be 0.5, could be 0.75, could be 0. They're the ones who are eventually going to call the shots. But it's interesting to note that the market is saying something different. Again, continuing our lower for longer theme.
So this is a little bit of a report card, if you will. So how's the Fed done? These are two measures of inflation, one called Personal Consumption Expenditures, or PCE. That's sort of the Fed's main target they look at. And then core CPI. That's CPI without the more volatile food and energy components. And for a very long period of time, the Fed has done, I think, a very good job of keeping inflation around that 2% central tendency. Recently, since the recession of 2008, inflation's run a little lower. And in fact, recently has dipped, and there was talk of deflation, and that's another worry. I think we're back to a point where there's enough inflation where that has sort of left the talk, but at the same time, inflation has been an issue. And you can see there's a quote by Janet Yellen here. So in October of last year, she said, the biggest surprise in the US economy this year has been inflation, meaning they expected there to be more inflation already, and there isn't.
The other story with the Federal Reserve is the balance sheet. And this is something that's different, I would say, this time compared to other recessions prior to 2007. When the recession of 2007 occurred, in order to really stave off the fact of being a full-blown depression, what the Federal Reserve did is, in addition to dropping interest rates, they went out on the market and they started buying bonds. They bought Treasury bonds and mortgage-backed bonds, etc. And they built up their balance sheet. And you can see prior 2007, it was less than $1 trillion, went all the way up to over $4 trillion. So, trillion here, trillion there, we're talking about real money after a while. And what you can see is that this slope here is very similar to the slope of the S&P 500. So in other words, as the Federal Reserve was increasing their balance sheet, the stock market was responding similarly. It was in 2015 that the Federal Reserve decided to stop buying bonds. And what you could see is, similarly, that was when the market actually had that still positive but significantly lower return in 2015. What's happening now is the Federal Reserve has said they are going to start decreasing their balance sheet. So it will be somewhat measured. They're looking at about a 10% decrease in their balance sheet in 2018. It's about 440 billion is what they're looking at decreasing. A lot of it, they're just simply going to have bonds are going to mature, and that's really what they're planning on doing. They're not going on the market selling the bonds, but still, that's something that's different. We haven't experienced that before. And so that's one thing that we're keeping our eyes out in terms of how is that going to impact the economy? Because that is, again, it's another tool that they can use to slow down an overheating economy. And again, when we talk about interest rates, where are we? Federal Reserve controls the short part of the yield curve. The yield curve being based upon maturity, what the interest rates are. And again, this is what the Federal Reserve can control and what they've been raising. Long-term rates, Federal Reserve has very little control over. And what you can see is 2013, long-term 30-year treasuries were at 4%, and at December 31st, they were at 2.7%. So a pretty big drop, relatively speaking, in terms of where we were. And what you can also see is that the yield curve itself has been flattening out. When the yield curve inverts, in other words, when long-term rates are less than short-term rates, that's usually signaled a recession. Currently, that's not the case. We don't see that happening from everything we see, but we do see that this yield curve continues to flatten out and continues that lower for longer theme. The 30-year Treasury rate is also highly correlated to inflation. So as the inflation numbers go, so goes this number. If there were to be a spike in inflation, this number would go up.
So another of the things we look at here is the trade-weighted dollar. The U.S. dollar is important because that's the price of goods and services that dollars cost around the world. So you can see since the lows of 2010-11, dollars appreciated almost 30%. So that's good news and bad news, depending on where you are. The good news is if you are in the United States, the dollar became more valuable. So that you could go overseas and you could travel and dollars worth more. Last year that reversed and the dollar dropped. And as we said before, that had the impact of actually boosting foreign returns because they were in cheaper dollars. But of course, there are other effects as well, such as now traveling abroad is a little more expensive.
So changing our focus a little bit from the United States to abroad, we think that the story is more or less the same. In other words, that this is actually right now, we're in a synchronized global recovery. Not only that, but what happened is that the United States took an approach of quantitative easing, of increasing the balance sheet, decreasing interest rates, of really trying to do whatever they could in order to get the economy back on its feet. That was not the approach that international markets and international central banks took back in 2007, 2009. Eventually, when their economies were not growing, they got the message and took the US playbook. And so what we think is that in general, other countries are basically behind the curve in terms of where the US is today. As such, we're very positive on growth outside of the United States, both economic growth as well as stock price growth, simply because it's kind of Again, what happened in the US is basically happening abroad, just at a different pace.
I just think one comment here that's we don't have a chart of it, but we mentioned PMI, Purchasing Managers Index. That's the level of goods that companies are buying, and in the global economy, PMI is positive for 99% of companies, meaning 99% of countries, meaning really across the globe, we are seeing expansion synchronized in a way that's very unusual. Really, it's really unusual that all countries are really expanding at the same time. This kind of shows it, but there's detail that go even deeper that show how coordinated this expansion is.
And the one thing we take with a grain of salt on this chart is that this is showing kind of the U.S. poised on this downward curve, and that's something that we're not quite sure of. We could easily see this curve kind of moving and just continuing back up as we're seeing this coordinated global recovery.
So internationally, we look at valuations across the world, and I think this is a pretty dramatic chart. What it shows is GDP and percentage of global market cap. So the U.S. has about 52% of the global market cap today versus 25% of GDP, while the opposite in emerging markets, only 11% of global market cap and 35% of global GDP. What does that mean? Basically, it means the U.S. is expensive and emerging markets are cheap. If you look below the bottom part of the chart here, you can see multiples of forward earnings. So the United States trading at about 18 times forward earnings, and emerging markets at about 12. Europe and Japan also a little lower at about 15. In general, you would think that market cap should be about the level of GDP, and so this disparity is pretty marked here. So one of the things that we would say is international opportunities really look positive relative to the U.S. today from a valuation perspective.
And again, another chart just supporting that thesis. You can see across the board, earnings is positive in the United States as well as in Europe and China and Japan, etc. Just very positive across the board. You can see that the U.S. was certainly ahead of the curve in terms of earnings relative to other countries. But those other countries are now catching up in terms of having positive earnings numbers, and seeing this, even just the slope of those curves is greater than currently the US, but the US has been doing it for a while. That in turn has led valuations. When we look at valuations, US is relatively more expensive than historical valuations, and certainly more expensive than international emerging markets. Despite the strong growth in international emerging markets in 2017, on a valuation basis, they still look relatively inexpensive, especially compared to the United States.
So this is 3-year rolling returns of emerging markets, and what it shows is that emerging markets tend to underperform and outperform in cycles. These cycles tend to be about a decade or so long, and we just came off a cycle where emerging markets underperform fairly dramatically. And I would say probably 18 months ago, if you sat here and somebody said, "Oh, you should own emerging markets," you would say, "I don't think so," because they have really been terrible for a long time. Last year, of course, they were the best performing asset class, and so now everybody wants to own them. And the question is, well, should you still own them? Well, based on history, our view is yes. They tend to outperform for a period of time, and this cycle could be really the early part of emerging markets having better performance.
So that being said, we've given you what we think are the positives in terms of the economy and the marketplace. But as always, there are headwinds and there are danger signs that we see as well. And so we want to talk about that a little bit, and what it is that we would say are the negatives that are out there. So the first negative is the Federal Reserve. We talked about the fact that the Federal Reserve is doing things to slow down the economy, increasing interest rates, decreasing their balance sheet. And again, we've also talked about over the long term, the Federal Reserve's record is that they don't lose. So the timing of how that happens, that we don't know. In general, their pace has been so far extremely measured, and it's nothing that we see on the horizon, but certainly that is a headwind to be aware of. In addition, stock valuations are at historic highs. U.S. stock valuations are expensive, and that's something that definitely hurts forward-looking growth. Economies at full employment. So again, that's a great thing in terms of where we are. But in terms of future growth, it makes it hard. It's hard for companies to grow if they can't find any employees to work the factories. So we do think that that is going to be a challenge for growth going forward. Economic cycle length, we've heard a lot of people talking about that. We think that's less of an issue in terms of the cycle length, primarily because of the fact that over the last 9 years or so, the growth has been so muted, comparatively speaking, but certainly something to be aware of. And finally, that inflation surprise. So it's the surprises that really can throw things out of whack. If there was an inflation surprise, that would not necessarily be good for the stock market.
So just a little bit of a focus on valuation. This is a very long chart. We go back to 1870, I think. So really interesting that we are at 26 times trailing 12 months earnings in terms of P multiples, and it's relatively high compared to history. There's been a time in the 2001 .com period where it went much higher, and the real spike you can see just prior is actually 2008, 2009. And it's not because valuations were so high, it's because earnings got cut so much. So it's kind of an anomaly. But we're getting that particular peak. If you look back, stocks look relatively expensive in the US.
Right. When we talk about PE ratio, what we're talking about is the price of the stock market, specifically the US stock market, divided by the aggregate earnings. So it's that ratio. The other thing is that we want to talk about is the central bank balance sheet is not only a local phenomenon. This has been an international phenomenon. As I said, that outside of the United States, other central banks took the playbook of the US and they went and started doing the same thing. And what you can see here is, this here is the US balance sheet, the amount of debt on the US balance sheet. And you can see all the other different central banks and the amount of debt on their balance sheet as well. So a lot of countries have a significant amount of sovereign debt. And all of these countries are talking about working to reduce their balance sheet. And we just heard, actually, European Central Bank said they're probably not going to do this in 2018. They're looking more towards the beginning of 2019. But again, as we unwind this debt on a global scale, that's a concern in terms of what's going to happen.
So this is just a representation of interest rates around the world. All these charts are the same, just the country is highlighted in each cell. So we're sort of the best in the bad neighborhood here. We're about a little over 2.5% in the United States, and you can see that the European Union is a little higher. Germany around 30 basis points, and Japan being the lowest. So on a relative basis, the U.S. interest rates are fairly high, which makes them fairly attractive on a global basis. People buying our treasuries is actually kind of good for us. It keeps interest rates low. So we're still in the part of the cycle where we're ahead of the rest of the world, and that continues to be a positive. The other thing that I think people wonder is, hey, rates are going up in the United States. The Fed's raising rates. What does that mean for my bond portfolio? And this shows different periods where the Fed has been raising rates and what's happened to bonds. And in most of these scenarios, bonds have performed just fine. Part of the reason is that lower yielding bonds are replaced with higher yielding bonds. Couple of the periods returns were modestly lower, but still, I think some of the concern about, hey, can I even own bonds? Is this even okay? I think the answer based on history is yes.
So takeaways in terms of what are we thinking and what does that mean for portfolio management, et cetera. And we're calling where we are today, we're calling this the punch bowl economy. And so what do we mean? So imagine you are at a party, and at the party there is a bowl of punch. And you have some delinquents who come into the party, and they decide that they're going to spike the punch. And they're going to take the vodka and spike it. And those delinquents are named the Federal Reserve, the European Central Bank, Bank of China, and Bank of Japan. And they're going to do whatever they can to get this party really going. And at a certain point in time, the party's fun. Everyone's having a really good time. But the party seems to be getting a little bit out of control. People are wearing lampshades. It's not a good scene. And the Federal Reserve is kind of the first one that says, you know what, I think we need to slow this party down a little bit. And they're going to do actions. The first thing they're going to do is they're going to stop spiking the punch. The second thing they're going to do is they're going to start removing the punch from the bowl, because we know that when the punch bowl is empty, the party stops. And so what we're starting to see is that we still have some delinquents that are out there that are still adding punch into the bowl and adding and still spiking the punch. But eventually those delinquents are going to stop, and actually they're going to turn into the parents and start removing the punch from the bowl. So right now we are in the punch bowl economy. In other words, we have the punch bowl is full, and everyone's having a good time, and we're seeing this robust growth. But at some point in time in the future, that punch is going to get removed from the bowl. And the question is going to be more in terms of timing and how long that will take. Today, the Federal Reserve is working at a very slow pace, a very slow measured pace. And so there's nothing on the horizon that we see, but we do know that markets go and economies do go in cycles, and that we feel confident that there will be another recession in the future at some point in time, right? We don't know when, and we don't know what year or how that's going to come about, but we believe that economic cycles are still with us for the long term.
I think to that point, we just want to add that economic cycles and market cycles don't really die of old age. They die because something happens, and it tends to be some kind of excess. So we saw in the 2007, 2008, 9 period, the excesses in the housing market and in the mortgage market. We saw the dot-com bubble in 2001. We saw the S&L crisis in the 80s and the 90s. And we saw, in the 80s, we saw the Iran oil embargo. We saw trade barriers put up. And so different things have always happened that have created a problem. So right now, we don't know exactly what that problem is. We don't know what it's going to be or when it's going to happen. But generally, something happens to end the party. Now, we know about the Fed. They're going to try to slow things down. They've been the ones that have actually tipped things at the end of the day. But generally, something else happens that is a catalyst.
We really recommend, in terms of thinking about portfolio construction, to remain diversified in terms of the portfolio construction and not really reacting to specific events, because it's really hard to know, is this the event? Is this the next S&L crisis, or is this the next 2009 recession? And the reason we bring that up is because since 2009, there's been multiple events that have happened that if you thought about them just standalone, you would be emotionally distraught. But what's happened afterwards has been that the market is more than recovered. So we do think that we're going to see more volatility in 2018. We think there's a lot of room for a lot of noise, politics in particular, and geopolitics. And we really recommend staying the course and not reacting emotionally to what's going on, because in the past, that has not served investors well.
Along the same lines, this chart shows annual returns of the stock market. And in every year, even in the good up years, which most of them are, the dots on the bottom show that there's been a correction of some sort during the year. So even in good years, it's not unusual to have the stock market down 5, 10% or more, and yet the year ends up positive. So we can't, again, predict when that happened. We expect it will, like historically it has. But the key here is to stay invested, because at the end of the year, in 7 or 8 times out of 10, the market performs well.
So I think we can say with confidence that there will be a pullback in 2018. And the reason we can say that with confidence is because going back to 1980, there's always been a pullback every single year. So we do expect, this year, we do expect more volatility than last year, but that's because there was no volatility last year.
The low bar.
So, yeah, exactly. So it's not really stating a whole heck of a lot. But again, we really urge investors to not get overworked up about a pullback, because there's always pullbacks in the market. And that really has nothing to do with, again, long-term returns. And same with, again, staying in that diversified portfolio and really thinking long-term. We really recommend talking to your advisor in terms of what should be your portfolio allocation, what are your cash needs in the, from now to the next 5 years or so, and really working that out with your advisor. Because what we've seen is that those investors who stay in and can stay in for a long period of time tend to do well over the long period. And you can see, even on a rolling 10-year period, yeah, there has been a few, or I think two cases of where the market has been negative on a 10-year period of time. But overall, that is a fairly rare phenomenon. Most often, the market has been positive on a long period of time.
So what's our outlook for the U.S. stock market? Well, clearly fairly positive. We think this growth recovery continues and picks up a bit due to mostly the tax cuts. Expansion continues with GDP growing around the 2.5% to 3% range. Earnings for the S&P 500 grow probably 11%, and that's a recent number, but it doesn't have the tax cuts fully baked in, so it could be a little bit conservative. Fed will probably increase interest rates 2 or 3 times during the year. Inflation, we think, will stay modest. This is a positive environment for stocks, and we believe the yield curve, kind of by definition, probably continues to flatten a bit.
In terms of cautionary, it's really not a lot to report in terms of things to watch out for. As we said, we think that there's going to be increased volatility, more corrections, certainly than 2018. Certainly, there could be some sort of outside shock that is not on our radar or anyone else's. Wage inflation could be one thing that could slow down economic activity. And then some sort of like cyber attack or geopolitical activity could certainly impact markets. But again, we would expect that to be very short-lived.
The international scene, I think we've pretty clearly stated that we think it's positive. The coordinated global growth is positive. European banks may begin to tighten next year. If so, it'd be late in the year is our guess. We are very positive on European stocks, Asia in particular, and emerging markets. And China, we believe, continues to grow at modest rates, probably 6 to 7% as it has the last few years.
Short-term rates, we do expect to rise. Federal Reserve has stated that they're going to rise, and we take them at their word. And on the long end, I think that's the big question mark. While we may see a slight bump up in long-term rates in 2018, we still think longer than that, that lower for longer theme is going to be with us, and that you're going to see interest rates on the long end of the curve continue to stay low and go even lower.
I think, Seth, just to give you kudos, last year Seth said, I think long rates are going to be lower this year, and they were. So I wasn't quite totally convinced of that, but you were right. And then I just want to throw out 4 numbers before we end. 181, 155, 153, 107. Does anybody know what that is? Those are expansions. So the first is the 1950s, 181 months. Then the 1980s, 155 months. Then the 1990s, okay, 153 months. We're at 107 months of this expansion. So people say, can this last? Yeah, I mean, historically, it's happened. And in each of those periods, the returns have been significant, 17 to 19% compounded over those decades of time.
So with that, we're happy to answer any questions that you may have.